Yes, my name's a mouthful, I know. It's Italian, and I'm Australian. I'm born in Australia. I live here, been living here for a while for my wife and 3 children. But yeah, it's awkward, so we'll talk about that just before the break. But thanks very much. Thanks for the opportunity to speak today. It's a delight to be here. As I said, I got out of an exec off-site, so that's always good. I'm going to talk a little bit about the Australian pension system, but not just because it's a history lesson about what's happened, but really more interesting what is going to happen. I'll make some predictions on that, and there are some things in play. And I actually think some of those things will transpire here in this market in the near future, simply because our governments pretty much all around the world kind of copy each other or catch up with each other. And so I think some of them are quite disruptive, and you should know about it, because as advisors, some of these things will impact you and your clients. And I think that's of value for you to know. But a little bit of history. I'll go back to this gentleman, Bob Hawke. He's our Prime Minister for 3 successive terms. He's offside of there. Paul Keating went on to win the following term. Arguably Labor's most successful duo, most popular, most charismatic. They've never had one like it. I think we've got an interesting scenario here in this country now for our current Labor opposition, but anyway, that's another story. But they really did do great things. But Bob Hawke is not known just for that. This is what he's really known for. Guinness Book World Record holder. Yes, that's right, 2.5 pints in 11 seconds. Not bad, eh? And he did that right here in Oxford because he was actually a Rhodes Scholar. So honestly, he was no fool. I had the pleasure of getting to know him at a function about 7 or 8 years ago now. It would be no, it'd be longer. It'd be 10 now, beg your pardon. And he still drinks, I can tell you that much. And he's a really charismatic but intelligent fellow. He really, really is. But you know, he did leave an amazing legacy. You know, he introduced the Medicare system, including the NHS. He floated the Australian dollar, completely deregulated the market in Australia, took away tariffs, it made it a modern economy. He fixed up the tax system, made it a lot better than what it was, but most importantly, he laid the foundation for what was the compulsory pension system, which we call superannuation. So, I apologise if I use that word a lot. I know people go, what the heck's he talking about? Superannuation, compulsory pensions. He didn't see it, by the time he finished his term, it was his offside of Paul Keating who implemented it. You know, the 3 objectives of the Australian system are pretty straightforward. It's pretty much, oh, that's a bit out of whack, isn't it? We're losing a few letters there. Can that be the res? Anyway, we'll see what we can do there. But, you know, it's pretty typical. And Australia has done a decent job now. We've had this system in for almost 2 decades now. It's still not in full swing, and I'll explain why. Because it started off a low base at 3%, and it's been going up. Now we contribute 9.5%. Let me explain in a couple of minutes. Reason why was pretty obvious. I'm sure you all know this. Life expectancy is the issue, right? Longevity. And longevity is continuing to go up and up and up and up. And the state pension liability, it was getting bigger and bigger. This is taken from the Australian Superannuation Funds Association. I think it's a very simple diagram which explains the problem. After 64, the state pension costs skyrocket, particularly on health and aged care. So if you can fix one of those, Dykes, and the one that you're trying to fix is age pension, then at least you're off the hook on one of them. Now, I do mean in Australia you are off the hook because it's means tested, so I'll come to that in a minute. So that's why they've done it. And this is where we are today. This has been the journey. It's a $2.5 trillion market, give or take 10% based on market swings. It's been, you know, is the 4th largest mutual fund market in the world. So Australia's built a huge amount of capital in that space. Now, I thought this was an interesting slide because it shows from 1992 to kind of present some of the big things that happened. And if you look to the early days, the introduction of it, they introduced some complex, I guess, issues to deal with. And in the last 10 years, they've been unwinding that and just making it more simple. So there's a point in question. You know, pensions are complex enough as it is. When we started on this journey, they made it even more complex with things like the surcharge, which was a special tax. If you earned over a certain amount, then you paid a high amount of tax on the earnings of your pension account. They introduced the low government, that's still in place actually, the co-contribution incentive, which is for individuals who earn not a lot of money to co-contribute, similar concept for their spouse, but they've simplified that. They lifted the preservation age from 55 to 60. It's going to go to 65. It keeps going up, no surprise. But since then, they've been doing things like RDR. We had that back in 2004. We've had other changes introduced like portfolio member, but it's the other way around, and I'll come to that later. And more recently, it's all about cost. It's all about making the cost of running a pension account as low as possible. So that's what they're really, really focused on. I just thought I'd show you this. This is interesting. This is where the money sits today in post-retirement world. It's an interesting slide because for some of you probably, you might not know this, but in the Australian market, more than half the money sit inside what they call a self-managed super fund, which is an equivalent of a SIP or a SAS in this country. So very much self-directed, self-employed. But the money, most of that money sits in residential property, which is strikingly different to here because you can't invest in residential property. So I thought that would be of interest to you. The rest of it sits in what we call retail funds, typically run by the banks, and not-for-profits. And that's another interesting dilemma that I would point out, that in Australia the banks have bought up all the platform providers, so that retail sector is dominated by bank-owned entities. It hasn't happened here, and when I go and talk to banks here, they still don't think it's going to happen. So it's really interesting how that's transpired. I thought this was interesting. This was the caption of a Sunday paper here in the UK about 6, maybe 5 months ago now. It said, if you want the best tax outcome in your life, in your work life, live in Dubai and then go and die down under. So you've got to move around. So that was an interesting caption. I had a read of it, and it had some of these points, not all of them, I've kind of extrapolated because I wanted to compare the differences between the two systems and where they are today, because this might give you a kind of insight to maybe where the British system will go in the future. So first of all, inheritance tax was abolished. That's why it's good to die there. So we had inheritance tax that's been gone, and it'll never come back. I think it'll be a brave politician that tries that one. The compulsory pension system was introduced in '92, as I said, started at 3%. It's been gradually lifted, so you have to contribute 3% of your ordinary earnings into a pension fund of some sort. It's now 9.5% right now. It's currently legislated to go to 12 over the next few years. However, a lot of argument there about it should be higher. So we contribute, like, for a typical person in Australia, they're contributing 9.5% of their earnings into their pension pot, which isn't bad because after 10 years, you've actually got a reasonable amount of money. So the young folk coming through, university graduate, what I call white collar person, they end up with a reasonable pot after 10 years, and they're very engaged. They really do know what's in their pension pot, especially because of mobile phone apps, and we'll come to that. The state pension is means tested, okay? That's a real big difference to here. So if you're now your house is not included, by the way, house is exempt, your ordinary home, but if you're sitting on a large plot of land, farmland, whatever, and it's worth a sizable amount of money, the government will take that into account and say, well, actually, you should sell that, because you could actually invest that into your pension or some other means, and you don't really need a state pension. Same the other way, income. If you've got huge amounts of income coming from buy-to-lets or whatever, it'll be taken away from you. That was done, it's always been like that actually, so, and there's a lot of talk about what the level should be, but it's not available, which is a difference to here. The other difference is that our contributions into our pension fund are taxed at a flat rate of 15%. So whatever you put in, if you put in $5,000 this year, you will have 15% taken out as a tax, flat rate. The earnings, as in the income earnings, are also taxed at 15%, and capital gains tax across the board for earnings, any movements you do, is a 10% flat rate. So it's taxed on the way in while it's there, but on the way out, it's tax-free. So drawdown pension, absolutely zero. And you can be fully invested a drawdown pension, and all the earnings it makes, capital gains, no tax. So the government is taking it on the way in, but letting you take it out. And they did that for a very simple reason. It was a lot of money going in, and it was just too good to let go. It started off without that, by the way, and it got changed. That's one of the changes and they're also talking now about changing that again. So that's an interesting observation, which is very different to here. This is similar, on death, 100% goes to spouse, dependents, slightly different. There's some tax rules around it. This next point always scares the life out of corporate trustees. We have, since 2005, got a legislation called member choice, which allows the member to tell their employer where they want their contribution to go to. It's not the corporate fund. It doesn't have to be the corporate pension fund. It can be your SAS or SIP or whatever it might be. Sorry, a SIP. Self-managed super funds. Staff in our business have got self-managed super funds. $110,000 is kind of viable to run one. So this really shook up the market, particularly the corporate trustee market. It collapsed the number of corporate trustees out there. It just wasn't viable anymore. The lifetime allowance, we had one. It's called the reasonable benefits limit. It was about $1.5 million. Sounds familiar. It was abolished after the GFC, just before the GFC, sorry, 2007. So now they're arguing amongst themselves, oh, there's just too much money in these, these funds. People got millions. Well, some people have. By good luck, they've invested in the right investments and they've skyrocketed. So it wasn't because it's a tax avoidance scheme, because the truth is we're capped about how much money we can actually put in there. So it's just good investment. But that's now under a lot of pressure to be reviewed. And now the annual allowance, that's been smashed. Since 2009, that's been reduced, and at the maximum you can contribute now as a senior person, what I mean by senior, 55-year-old plus, is $35,000, similar to the Americans, but $25,000 if you're under 55. So they've really crushed that down. The other big change more recently, and this is about costs, bringing costs down, every retail fund must offer a what they call a MySuper compliant fund, which means its costs are capped at 75 bips, and it must offer a lifestyle investment offering, something that's simple and I don't have to worry about. It's kind of, there's different names for this, lifestyle funds, date-based funds. Simply means they really take into account what your age is and what your risk profile should be, and therefore they'll allocate you to an appropriate fund for that. That's actually been good. I think that's been really good. And that with the combination of 2004, where charges had to be, like RDR, had to be present on people's statements, it has made a big shift of moving money away from high-cost funds, which has been good. Pension freedom's been around a very long time. I'm going to talk about that very soon. And preservation rules have moved. And finally, this is the last point, we can contribute 3 years in advance, not 3 years in arrears, which is completely different to here, and it's $450,000. It's a really strange number, but that's the number. Now that was done because we're in transition, and some of the folk who are approaching retirement age and haven't been in the system for their full lifetime didn't have a lot of money in their pension funds, so this is a way the government could bring some money in and kind of entice people to get money in there. So that's a really quick example. So now, a lot of people say to me, that sounds great, Rob, but it is actually only, according to Mercer's, the third best system in the world. And there are problems with it, and I haven't really gone into that yet, but there is improvement that can be made. And that improvement, if I look at the journey ahead of us, if you look at this key issue, which is annuities, we have 0 annuities in the Australian market, or close to. It's like 1% goes into annuities. But you really do need annuities when you look into the longevity risk issues that we face, and that's an ongoing drama, particularly in Australia. Australia has a very good longevity number for both male and female, and it's increasing year on year. So they need to do something. Now, the government knows all this. They instituted a review. Annuities was at the top of the agenda because they do see it as a problem. Because once you do use up all your pension fund, you do fall back onto the state pension. It is a safety net. That's how it's considered. So it's not that you can't get it. It is always there to be available should you need it. If you've basically used all your funds and you've got nothing available, you fall back on the state pension. Problem in Australia is next to nothing compared to other countries goes in the state pension. So they commissioned this fellow, David Murray, for the Financial System Inquiry in 2014. He came up with a number. Now, David Murray is a very good financial services person. He ran Commonwealth Bank for many years. He's now running the Sovereign Wealth Fund of Australia. And there are impediments for annuities in our market, interestingly enough, both tax-wise and product-wise. There's a big push right now on to take those obstacles away to make annuities more readily available, particularly for deferred annuities. And they need to have more product development. There's really only one provider in the Australian market, two, but one main provider called Challenger. That's it. No, they're not compulsory, by the way, of course. Now, the other controversial issues I wanted to talk about. So we're running now at 9.5% going to 12, but all the analysis shows you actually need 18% contribution to have a half-decent pension to live on. Like if you look at a DB plan, that kind of costs 30% of people's salary. You end up on some sort of system at the end. We're only contributing 12, it's not enough. Singapore contributes above 20%, and they've had that for a very, very long time. So that's one of the issues we've got. The costs of running pension funds are still very high compared to other countries, and that's where the government is really focused on that. We have a few advice scandals. I don't know if any of you have seen the scandals that some of the banks have been having lately. They've been pretty bad. So the trust in the community is low, particularly in the younger generation. It's very, very low. Interesting dilemma that accountants are perceived to be more trustworthy than financial advisors, and they're the ones that are actually selling these self-managed super funds at not way above what an advisor does, because they get all the bookkeeping fees of keeping a self-managed super fund compliant. So it's a really quite different scenario to this country. And as I said, a lot of the money ends up going into high risk, well, I consider it and what the government considers high risk, which is residential property with negative gearing, with gearing. In Australia, we can actually make losses on an investment, and those losses get carried across to your other income. So it's called negative gearing. So it's huge, and it is a problem because it exasperates residential property values. And the last thing is that, when you look at the asset allocation, the self-directed investor doesn't really do a good job of where they put their money, which is kind of nonsense. So the government knows all this. They commission this folk, the Productivity Commission. The Productivity Commission's job is to look at systemic issues in the economy and what can be done to improve it. They went into some detail. They had a look, and this was the thing that they were most worried about. Do people blow their lump sums, which is kind of what we've got here with pension freedoms. So they went off and did some very good research, and they started off, here's an interesting fact, if you actually look at the amount of money that's out there, remember we haven't had this superannuation system for long, a lot of people have got next to nothing, and some people, at the top end, only 10% have got, my age bracket, have got about $230,000 on average. A long way, not enough to retire on if you want the government to actually be off the hook, as it were, without having to do any funding. The money where it's allocated, so you can see those age brackets there, that's kind of similar to this country as well. I've done comparisons, it's not that far off, probably a little bit more in pension pots because we've got the compulsory side, but a lot of it's still tied up in housing. And that's another interesting comparison. And I think this is interesting when you come to see, okay, what do people do with pension freedoms? Do they take out a lot of money? Okay, someone with $50,000 takes out almost half, but I'll show you where they spend it. But someone with like a high net worth person, say over 300,000, takes out next to nothing, 4%. Average is around 17% across the population. So it's not too bad. In fact, they were surprised by this research. And this is where it goes. About a quarter goes on paying off the home or improving it. That's good. It's an asset there still for them. 18% gets moved somewhere else, like a bank account. I'm not quite sure why they do that because there's so many benefits keeping it inside the pension. Then it's moved over into another scheme. That's still investment. And only the last couple, clearing off debts, car, holiday, it's not a huge problem. And as you can see right there at the bottom, only 1% goes towards buying an immediate annuity because there's really no incentive to do so. So from there, they concluded, well, it's not really a problem. Lump sums, we can leave it the way it is, but what we should do is make people work for longer. Gee, thanks. Terrific. That was good. So, hey, but no surprise. So the changes that I think are really interesting coming up. The Murray Report's going to do some systemic changes across the financial services industry. I won't go into that because a lot of it's got to do with tax, actually. But compulsory annuities, I think, are actually going to come back into Australia, are going to be made a requirement rather than, as it is here now, not a requirement. I think the really interesting change, though, is the fintech space, which was touched on before. This is the area that's the most dramatic change, right? Technology and consumer behaviour and the way individuals are now engaging with the finance industry is changing dramatically. And digital along with D2C, on direct-to-consumer, is the big thing. And everyone's doing a low-cost proposition of some sort because they realise they need it. Now, why do you need it? Because if you look at Gen Y, these individuals, and I know a lot of you, probably your client bases are much more mature than that, because these guys have got next to nothing, but they are the upcoming future clients, and they're all about being digital. They're just digital. Their whole life is about a phone or an iPad or whatever. They're very connected. They talk to each other by text. They interact by text. They actually prefer talking to machines than people, and it's getting worse. So, and it's an interesting thing because if you look at robo-advice, again, something that you should be aware of, that says a lot. And you need to be aware of it because if you're not, you end up like these guys. Extinct, dead, finished. All of them have been impacted by technology, some shape or form, and it's only getting worse because there's about 12,000 startups, fintech startups out there in the world that want a bit of your lunch. They're all looking at ways to take it. Now, so far, the majority of this effort has not been in your space. It's actually been in the space of payments, and FX. It's all got to do with that. Alibaba, which was mentioned before. This wasn't mentioned, I think it's really interesting. They account now for 50% of all online payment transactions in the industry, and not only that, they've got the most, this is an amazing success story, right? 4th largest market money fund in the world, and they did that in a ridiculously short time frame. And it's because they're facilitated, connected to just about everyone, particularly the merchants and a lot of retail folk. Now, they've got big plans, and it's really interesting how they've dominated that space, particularly in China. But it just goes to show how fintech disruption can really change the marketplace. And then there's Bitcoin and there's all these other things that are happening parallel to that. And as I said, if you look at those 12,000 disruptors that are out there, and that's a growing number, there's a lot more to come. Now, that's interesting because the government then realised we need to do something as well in this fintech space and get technology ready. In Australia, they launched this thing called SuperStream. SuperStream is all about taking paperwork out of the pension processing, well, out of the industry, basically. And for example, a pension transfer used to take, on average, 30 days, 30 business days. It now takes 5. And that's because it's fully electronic and it has to be done. If you don't do it, you get fined. So the government, the regulator is right on top of you. It's all about one click, simple, make it easy. This has scared the living daylights out of everyone in the industry. So everyone's rushing out new products to accommodate for this. And they're also doing mobile projects first. Desktop is dead. Forget the desktop. It's all about being on phone, because average person looks at their smartphone 150 times a day. So that's pretty good capturing. Look, I thought I'd throw this up because it does show the current, what was the old situation where money moved around from the employer to the employee, to the trustee, to the custodian. You can see it's a convoluted mess. It takes a long time. That's just for a contribution. It isn't, you know, it's probably simpler, but when you look at a pension transfer, it was pretty ugly. And SuperStream was all about making that simpler, taking out the cost, taking out the amount of time. Just make it simple, make it electronic. And we did this in 18 months, which is unbelievably good. We set up a gateway for our clients. We now do 3 million transactions a month, and it's just growing. Because we've started with the big employers. The law said that if you're over a certain size, as a big corporate, like FTSE 100 company, they were the first that had to go, and it's been trickling down pretty much the same way that's been working here with auto-enrolment, if you can compare it. And now we've got this really simple process. Straight out of the payroll, transactions go through the gateways, the money gets allocated to members' accounts. It is dead simple and clean and fast. So the benefits of that have been enormous. First of all, timeliness, as I said, 5 days for a pension transfer, not 30. Reduced error rates are dramatic. There's more and more information. We've only had it for 12 months, right? So it's only really been running for a good 12 months now, but it's really starting to show the benefits in a big way. So the government's on board. They figured out that, well, we better hop on. Now they can do information like RTI, the same way we have RTI here. They can know how much has been allocated to people's pension pots. You know, are they going over their limit? Are we taking the right amount of tax? All that stuff is now real-time data. So there's a whole big data exercise around this. Government's loving it, industry's not. Oh well, that's the way it goes. So I thought I'd show you another aspect that's really interesting, because I mentioned before the 150 times a day. Could you kick off this? And it's all about an app one of our clients run. It's a bank.
The
It's all interrelated.
ANZ app makes it easier to manage and grow your money. You can do all your everyday banking, take charge of your ANZ Smart Choice Super and start share investing, all with the protection of a secure 4-digit PIN. Download the new Grow by ANZ app today.
Yeah, so that's really quick and brief, but my point is this. So ANZ, for example, all the main high street banks have all got customers from cradle to the grave, and I mean that with their pensions as well. So they have now got apps that not only can you look at your credit card, your mortgage, your bank account, you can look at your pension, you can look at your anything that's happening with your pension account, investments, all in one place. And that's been taken up at a rate of about 60% of their clients have taken that up. So it's interesting to see how engagement has changed from 10 years ago. 10 years ago, at best, you would get your statements for each one of those accounts, whether it be monthly, quarterly, half yearly. Now people are getting it every day, and some people get it twice a day. So that's the kind of volume of change that we have of interaction. And what that SuperStream exercise I spoke to you about, this is another really good example where we built for ANZ. You can now round up your pension pots with 3 simple clicks. It is this simple. I'll show it to you. This has had another dramatic change for the good, because people are now consolidating. So I'll just run this and show you what I mean.
To ANZ Internet Banking and ANZ Smart Choice Super's innovative paperless transfer service. There are no more paper forms or digging around for your fund details. You do it all online in just a few clicks. When you're in ANZ Internet Banking, simply click on your ANZ Smart Choice Super account. Your other super funds are displayed, ready for you to transfer. Read and agree to the terms and conditions first. Then click on Transfer Now. It's that simple to say goodbye to multiple super funds and multiple sets of fees. Get started by opening an ANZ Smart Choice Super account today.
So that fund has now got $2 billion in it. They've done it without any advertising. It's simply an option on the app. It's an option. The banks, when you walk into a branch, they'll tell you about it, of course. But by far, it has come through the app. So it's that, and that's been, it's just been that easy. And how it works, just so you understand, is that all the pension fund providers now have to have an electronic gateway that supports different messages. One of the messages, tell me if you've got an account for this NINO number. We call it a tax file number, but it's a NINO, right? And it'll say, yeah, I've got this. So Rob DeDominicis, if I log onto that app, I can see all my pension pots, and I can just say, transfer them into this account. And it sends out the message, and 5 days later, it should be there, which is amazing, right? Now, that's one of our clients. I'll just show you. Now, the next chap is a guy called Patrick Clark. He is the product owner of this and platform director. I'll tell you what he has to say.
Who had 17 super funds. Any time they thought about doing a consolidation of those 17 funds, they were just overwhelmed by the concept of filling out 17 forms, getting 17 sets of IDs certified, sending them off to 17 different organisations. You can imagine how overwhelming that is for anyone. That person using our online service consolidated those 17 funds and had all the money sitting in their account within 2 weeks. And the benefit for that individual was that they saved $820 in dollar-based fees alone by doing that.
Yeah, sorry. For some reason, the very first bit didn't play, but he was talking about their poster boy example. Their best example of where this has really worked was an individual who had 17 different pension pots. And that person was overwhelmed every time thinking about trying to do 17 transfers, but because of that app, it made it so simple, and they did it, and off it went. Now, they did it without any advice. So, you know, there's a question mark about, well, is that actually a good thing? Yes or no? Now, Patrick says to me, well, you know, Rob, no advice. It is a self-directed proposition, so it's up to the individual. The truth is, now with My Super, the proposition they're going into, which is this new product, is good. It is really low cost, and I would be really surprised if what they've come out of is better. But hey, look, I'm not saying that there's no role there for an advisor. Don't get me wrong, but it is interesting that that's what's happening. Look, and the other really interesting innovation, I go back to Gen Y, is just the use of YouTube, video, audio, video, all this stuff it's really profound. This is another one of our clients. It's BT Westpac. They now do the statements as video statements. You don't have to get a paper statement anymore. You actually get a personalised, individual video file, and it's all about you. And I'll run this because it's really good. It's very clever.
Hello, Dylan. Back in August,
this is the video. This is what it looks like. Okay, this is what you get.
Your 2014 BT Super for Life annual statement was ready for download in your Westpac online banking. To support your statement, we've created this personalised video about your super. In it, we'll provide a summary of last financial year's transactions and estimate your balance at retirement, as well as your monthly retirement income from this super account. We will also provide you with a link to our retirement income calculator so you can assess your current position. So, let's start with last financial year's opening balance on the 1st of July 2013. After adding in all contributions and investment earnings for the year, plus rebates, minus account fees and insurance fees or premiums paid, and also taking away government taxes, you finished the financial year with a closing balance of around $1,500. Assuming your contributions stay the same and that you retire at age 67, we estimate that your BT Super for Life balance
So
of
do an
around
illustration pretty much
$145,000.
online. Yep.
That balance will provide you with a monthly income of around $700 per month to last for 25 years. So how much is enough in retirement? The Association of Superannuation Funds of Australia estimates that for a comfortable lifestyle, a single person would need about $3,500 a month, and a couple would need roughly $4,800 per month. Of course, this depends on the kind of lifestyle you want. For example, you could work towards a possible retirement income of 65% of your current salary, which would be made up of your income from your super balance and any other savings or investments you have, plus, if eligible, the government age pension. Now, we've made a number of assumptions in estimating your retirement balance from this super account. Make sure to check out our retirement income calculator and put in your own numbers to get a better idea of where you might land. You can see how adding extra money to your super can affect your balance. Plus, we'll also offer a number of strategies you can consider.
So you can sort of see where that's going. Yeah, look, I can't compare the FCA regulatory requirements back to the Australian ones, but they're similar. Don't discount it. They are similar. But you can kind of see where this is going, right? I mean, that is a pretty good engagement with an individual. You know, it's video, it's so easy to consume, it runs off your phone, especially with a 4G network, that runs really well. I've run it before. It's completely changing the marketplace, right? Sorry? it is a completely new way. And look, with Gen Y, they expect this. They don't tolerate it. I mean, they just are not engaged with paper. For them, it's just a waste of time. And that with robo-advice, and that's kind of not really robo-advice, but it is the stepping stones towards that more and more and more. So, you know, just so you're aware, think about that. You know, I'm not here to profess some sort of global shift, but it is happening, and it will happen over time. So that's my presentation. So thank you very much. You got any questions? Thank you.
5 minutes if you... Yeah, got 4 or 5 minutes of questions if you want them, please.
Yeah.
And if you could wait for the microphone, that'd be brilliant.
Just on the level of contributions that you mentioned for individuals,
Yes.
is that in addition to the compulsory employer contributions in Australia?
No. The employer must contribute 9.5%. Is that what you mean?
Yeah.
I can top that up to my limit. So if my employer contributions came to 10, I could add in out of my tax. My pre-money tax. I can get the tax back. So just like we can here, it's the same. But there's always a cap at the moment, which is the same as here. Really, it's quite the same. So did I answer your question? I missed the first bit.
So the employer has to pay 9.5
Yes.
for everyone, and then the individual can top up pay as well.
Yes, you can. Yes, you can top up to the limit. Yes. Yeah.
The individual's not compelled to pay anything.
If you could wait for the microphone.
Sorry. So the question was, are any individuals
Compelled to pay anything.
You have to. It's compulsory. It's the law.
Sorry. You're saying the company pays the 9.5, yeah?
Yes, out of their gross.
If they paid the 9.5, does the individual have to pay anything?
No, that's it. It's done.
Okay.
Yeah. So it's a really quite different way of thinking in Australia. People think of their gross package, and the gross package, you know, is always with the 9.5% on top. So you always think of it as your gross because people see it as it's your money. Just the employer's paying it. It's 9.5% of it away into a super fund. Yeah. It's like salary sacrifice. Spot on. Yeah.
Gentlemen,
it's a different way of thinking.
On the left-hand side there.
Hi Rob, thanks for that.
Welcome.
You mentioned very quickly about portfolios member. Could you just outline how it works in Australia and whether you think it's a step that the UK needs to take to increase people's savings? Yeah, look, portfolios member, as I said, it's called Member Choice. It's been around since 2005. It's like our company, as I said, we almost pay 40 out of 40 something odd payments going to different pension pots. People like it. It works. We offer a corporate plan. Not everybody takes it, and we offer incentives in that corporate plan, like insurance, life insurance, health. But they choose not to take it for whatever reason because the deal they've got somewhere else is just as good. It does work, it definitely, and it has lowered costs, and I think it's better.
Last two, this lady here.
Hi. Obviously, in terms of the pension transfers in the UK, do you think the FCA would ever consider removing the requirement for advice so that you could just do a one press button and transfer all your funds? What do you think the likelihood of that is?
Good question. I can't speculate on that one. Would it ever do it? That is a self-directed proposition. It's an individual making their own mind up and allowing them to transact that way. I can't see why not, but then again, I'm not. No. Yeah. Okay. Fine. I can't see why not. So
I'm going to have last two. There's this gentleman here, and then I will come over to you.
Yeah.
Thank you.
Self-employed.
Yes.
What's the situation with self-employed?
Same.
So they would pay the 9.5?
Yes.
Yeah.
So I was self-employed for a long time, and I would, if I paid myself a salary, not dividends, okay, if I paid myself a salary, I had to make my 9.5% contribution. So if you earn more than $500 a month, you're obliged to make a contribution to your pension. Yeah. Yeah, there's no difference. And the tax office doesn't like it when people pay themselves only dividends. Because they're thinking, well, hang on, you should be also paying. They will question you. They'll give you a very hard time. In the end, you should just pay yourself a salary. Yeah.
Last one over there, sir.
Yeah, just a quick one about advisors. Obviously, the one thing we haven't talked about is, have the advisors been obliterated in Australia?
Oh, no.
Or are they just making money differently on fees?
No,
because
no.
we'd love to have a simplified transfer in and then manage that money.
Yeah, no, look.
And also other super funds, the default funds we have here are getting massive amounts of money already.
Yeah, same in Australia.
So what's the performance been like on those? And can they choose any funds once they're centralised?
Like performance is driven by where the asset allocation is.
But are they mainly trackers?
But generally it's been pretty good. Look, advice in Australia is alive and well. So much so the banks have bought 75% of it. So it's integral to people really understanding what they need to do in retirement. Particularly when you approach it like here, 55-year-olds up are looking for advice because it is complex. It's by no means simple.
But having got the cost down on the funds and on the platforms, we would love simplified transfers like that. That would be fantastic.
Yeah, it would be.
But are they earning on a percentage basis or fees most of the time?
It depends. My mother is with an advisor who pays. She is charged a flat fee per annum. I'm with an advisor who charges me basis points. So it depends. It really depends on the proposition. My mother's in simple ETFs and some simple funds. I'm not. I'm in high, so I get advice. So it just depends on what you need, I think, or what you want. Yeah.
Thank you very much, Robert. We have
Terrific.
to. I mean,
thanks very much.
Brilliant. Thank you very much.
Thanks again.